Okay, what is up, traders? What's up, tycoons? Super excited for today's video. We're going to break down TLT. Going to give you guys a really in-depth chart analysis on that. Go ahead and cover all of the technical signals that we're looking at, some of the signals that we're looking forward to play out. But before we do that, okay, there's some important data. GDP has come out. We have the whole debt ceiling debacle, right? The whole debt ceiling disaster. So we're going to cover that in a few slides, all right? Go over some important charts and data before we get into TLT itself. So if you guys wanted to look just for the technical analysis, all you have to do is fast forward to the later half of the video and you can jump right in to the charts. But before we do that, we'll go ahead and proceed with our slide presentation. So legendary investor Jeremy Grantham says the stock market could crash 50% this year as the bubble enters its final phase, right? The stock market is poised for another 20% decline this year as the bubble enters its final phase. Grantham said that in a worst-case scenario, the S&P 500 could fall upwards of 50% from current levels. He thinks investors are putting too much weight into the idea that the Fed cutting rates is a good thing. And we're going to go over some slides to show you guys why that may not be a good thing, even though everyone's so anticipating it as a good thing. Now over here, what we're looking at is this is going to be, if we actually do avoid a recession, okay, and the Fed is able to accomplish this soft landing, which historically the Fed has not been able to accomplish a soft landing, then the lows are in. Okay, so we're comparing a few different timelines here, and the other one's the purple is the current data. Okay, this is the current market data. And over here, we have the 60s, we have the 80s, we have the 2018 crash. And, this is basically just showing and highlighting that the lows already would be in technically if we avoid a recession upcoming in 2023 and possibly even 2024. But if we do enter a recession, a bear market combined with a recession, it's a big drop, right? The bear market has further to go. This is where we're at currently, okay? And then this is the 1929, the 50s, 60s, 70s, 80s, okay? We have all the different bear markets combined with a recession. And you can see that potentially we have a lot more downwards to go. So, that's one thing that I'm a little bit cautious of, right? Doesn't mean that you can't still dollar cost average into long-term, index funds and things like that. But when choosing individual stocks, not even all stocks are around 20 years later. So if you're really looking for a long-term mindset, just focus on, just dollar cost averaging into the indexes and be a little bit patient, okay? Because if we do end up getting a recession, then there could be a lot more pain to go, as this chart right here exemplifies. Okay, now the GDP report just came out and there's an ominous Great Depression warning sign not seen since 1932. And one of the first, red signs that we saw basically was that the growth in inventories, which accounted for half the GDP growth in the fourth quarter, this is not a good sign either. It's the result of businesses being unable to sell off existing inventories at current prices. Liquidating that inventory at discounts will mean lower profits and a further drag on future growth. The most troubling information in the GDP report is the precipitous drop in real disposable income, which fell over $1 trillion in 2022. For context, this is the second largest percentage drop in real disposable income ever, behind only 1932, the worst year of the Great Depression. Meanwhile, the federal non-defense spending grew 11.2% in the fourth quarter, another example of politicians feeding the federal budget while starving the family budget. Okay, now we have, the whole debt ceiling crisis right here. Okay, we're going to cover that real quick. So the debt ceiling increase sends Dems into full apocalypse mode, chaos, recession, global financial crisis. Democrats warn of economic meltdown several months before a debt ceiling increase is needed. The prospect of negotiating a debt ceiling increase with Republicans is prompting warnings of economic ruin and chaos from President Biden's White House and Democratic leaders in the House and Senate. Now, what might happen if there is no agreement to raise the debt ceiling by the summer, and not the far more likely possibility of agreeing to spending cuts, as we just take a look, they're starving the family budget, but they're feeding the federal budget. They're not looking to do any type of cuts. So when it comes to agreeing on spending cuts at the federal level over the next few months in return for an increase in the government's borrowing limit. The Democrats' dire prediction started with Treasury Secretary Janet Yellen, who told House Republicans last week that a debt ceiling hike would be needed by June. So that's kind of the timeline that we're looking at here, is that, the Dems they're really pushing for that debt ceiling, to increase by June. And it's basically the end of January right now. Now, this is the current US debt ceiling. I mean, look at this. The debt ceiling is in black, okay? Total public debt is in red, and then we have GDP right here. Look at just look at how much this debt ceiling has grown and how much America has really gone into debt when it comes into the trillions, right? In 2000, we were right around a $6 trillion debt ceiling, and now we've gone all the way up to 31.4, which is just absolutely wild. Now, a really good resource that you can use is the usdebtclock.org, and these numbers update every single second on there. So it's really useful if you're interested in, basically tracking the US debt. This really breaks it down for you very nicely and gives it to you all in a nice chart. And when you're on the website, all of these numbers are updating live every single second. So it's a really useful tool. Now, the debt limit fight risks early end to Fed quantitative tightening. Now, quantitative tightening, QT, is something that we've never seen in the history before. We've had quantitative easing, right? They introduced that, but they never introduced quantitative tightening. The Fed has penciled in shrinking its bond portfolio into 2024, and economists see rising risk that the Fed will need to end its plan early. The Federal Reserve's quantitative tightening program risks being propelled toward an early end as U.S. politicians bicker in Washington over raising the national debt limit. By shrinking its bond portfolio by up to $95 billion a month, the central bank is draining liquidity from the U.S. financial system, complementing its interest rate hikes in the battle to control inflation. An early end to QT would therefore provide the U.S. economy with some relief. And that's very true. But, is that going to actually be good for us, right? That's the big question, right? It could provide some relief short term, but overall, in the grand scheme of things, will that actually help the economy in the long run? Ironically, what could have an even more powerful impact on bank reserves is an ultimate end to the debt ceiling impasse. Once the Treasury has a free hand, it's likely to unleash a massive series of bill sales in order to raise cash, mopping up so much that it could cause a sharp contraction in bank reserves. The T-bill supply could surge by some $500 billion to $800 billion over several months. Now, how is this really going to be affecting everything? Okay, what we're looking at right now is the National Financial Conditions Index along with the Adjusted National Financial Conditions Index. That's what these two are going to be right here. And then we have the S&P 500 in this tealish blue color right here. So if the debt ceiling gets raised, financial conditions are going to be even looser, right? They're going to get even looser. Remember, Jerome Powell's mission in 2022, throughout most of 2022, was to tighten financial conditions. And that's what we saw, right? As soon as we started to see financial conditions start to trend upwards, right? So over here, they're trending downwards. We're seeing the S&P, we're seeing the stock market go upwards. But as soon as this starts trending upwards, you can see that the stock market has been falling as national financial conditions have been loosening. Okay. Now, each time we've hit a peak in financial conditions, we've also hit a bottom in the stock market. Okay. And you see they start to come down and then the market rallies a little bit, but we've really been rejecting this trend line here and we're starting to break out of it. Okay. We're trying to get a nice breakout of this trend line. And if you take a look, this is the Jackson Hole speech right here last year. Okay, this is the time period of the Jackson Hole speech. And you can see that financial conditions hit a low at this point, right? They made a new low. And what's extremely bizarre to me is that the Fed has increased rates by 275 basis points since this time. And financial conditions are actually looser than what they were at the time of the Jackson Hole speech, which is pretty wild if you think about it, right? The whole reason for raising these, the rates, 275 basis points, was to tighten financial conditions. But rather, financial conditions are even looser. And if that debt ceiling gets raised, the financial conditions are going to get even more looser and continue to go down. And as this happens, you can see that there's a divergence, right? So we're making lower lows here, but we're starting to, really trend more in an upwards direction here and really try to get a breakout. So it's going to be really interesting to see how this progresses. I've been tracking this for a while now, and it was a very useful tool, but that system could be broken as we see, financial conditions are really just plummeting and loosening up a lot. Now, the next slide is going to be basically the percentage of investors expecting lower versus higher bond yields in 12 months. So if you take a look here, the lower is going to be in this darker blue right here, kind of like this navy blue, and then we have this sky blue or ocean blue right here, saying that rates will be higher. So if you look, the percentage of investors has actually crossed below now of people that think interest rates will be higher, and they're starting to predict that interest rates will be lower over the next 12 months. Remember how the relationship between the rates and the actual price, as rates go up, price goes down, right? That's why TLT has been dropping so much, is because the Fed has been raising rates. So if rates do actually end up coming in lower, right, and rates go lower, then the bond market is actually going to start going higher in terms of price. Now, this is what I mean by people have been calling the Fed's bluff, and they're actually pricing in a more dovish Fed than anticipated, right? He's not really given any signs of cutting rates, and people are actually starting to predict, and the Fed fund rate futures market is predicting around 50 points in rate cuts by the end of the year, even though we still have a meeting where we're most likely going to be increasing the rates by another 25 basis points, and possibly again by another 25 basis points in the next meeting. They're still predicting that they're going to pause and then end up cutting rates. Now, if you take a look here, this is really important to note. And what we're looking at is going to be the Fed funds rate. Okay, that's going to be this here in blue. And then we have some of the other treasury yield rates. So I have the 2-year bond rate, the 10-year or the 10-year, 2-year yield, 10-year yield, and 30-year yield. Okay, if you look, all of those are now lower than the Fed fund rate. It's actually above. And the reason that this is important, particularly on the 2-year yield, we'll go into the next slides, is if you see here, that has predicted a recession many, many times before. Okay, so what we're looking at on these slides, we're going to go through a few of these slides, but this is over here in the early 80s, and you can see the Fed funds rate is up above. These shaded areas on the chart are recessions. Okay, these are recessions. So as you see, the Fed funds rate is up above the 2-year treasury yield, and we end up going into this period of a recession in the 80s. And then what do you see? It actually goes below, it dips below for a little bit and starts trending below. We cross back above, okay, and now the Fed fund rate is back above the 2-year treasury yield. And then what does that happen? We have another recession here in the future. This happens time and time historically, really many, many times. So if you can see, that's what we're going to be looking at. But Fed funds rate up above right here, okay? And then in the future, what do we get? Recession. Okay, so it's not meaning that we're about to get a recession next month or, in 2 months. It just means that, within the next year, there's a good chance that we could end up hitting a recession. Now, whether it's 7 to 8 months from now or 12 to 14 months from now, again, you can't really call the shots that well. But over here in the early 2000s, we see the Fed funds rate goes up above. Okay, and then by 2001, we're in a recession. Over here in 2007, okay, really in about the later half of 2006, Fed funds rate goes up above the 2-year treasury yield. And then what do we have? We have the 08 financial crisis, and we get a big recession in 2008. Same thing over here. Now, this is COVID in particular right here, but it's still just pretty relevant, right? I mean, look, the Fed funds rate was rising. And remember, Donald Trump was talking about firing Jerome Powell if he didn't start cutting rates. And, sure enough, that's what ended up happening. But, early in about the midway of 2019, we can see the Fed funds rate is up above the 2-year treasury yield. And then in 2020, we get the COVID crash and the COVID recession, but maybe that was going to come anyways. So again, just to highlight where we're at currently, again, this is the Fed funds rate, and the 2-year treasury yield is below it. So there is a good chance that we could see some type of recession over the next 7 to 14, maybe 15 months. Now, Jamie Dimon says rates will rise above 5% because there's still a lot of underlying inflation. The Consumer Price Index measures the cost of a broadcast of goods and services, rose 6.5% in December from a year ago, marking the smallest annual increase since October 2021. Now, Diamond said the recent easing of inflation comes from temporary factors such as a pullback in oil prices and a slowdown in China due to the pandemic. Now, this is something that I've been highlighting in a few of my videos as well when it comes to the energy market, is that a lot of this was due to the pullback in oil prices, and it really China just reopened, and if they're going to stay fully reopened, that could be bad news. We've had the benefit of China slowing down, the benefit of oil prices dropping a little bit, but I think Diamond says that oil gas prices probably go up the next 10 years. China isn't going to be deflationary anymore. Now, if you take a look here, this image, I don't know why it's so blurry, but basically this shows you that the percentage of, countries that trade with either China or the United States. And China trades with over 70% of the globe. So when you think about that and you think about the demand for those oil and gas prices rising due to the fact that China trades with pretty much the whole entire world and most of the whole entire world, that really could cause CPI to stay elevated longer than what people think. And if that happens, that may cause the Fed rate to stay elevated longer than people think, right? We looked at a chart earlier. Most investors are pricing in a lower rates in the bond market over the next 12 months. But will we actually get that if China causes CPI to go back up? All right, so that's something that we need to keep in mind. Now, we're going to come over here and look at JP Morgan and a couple things that JP Morgan has said. Jamie Dimon, which that's who we were just looking at, he doesn't have a great track record all the time. Okay, so you have to take the things that these articles are putting out, these headlines are putting out with a grain of salt, and actually do some of your own research, right? On May 25th of 2022, he said Bitcoin has significant upside from here and could rise to 38,000. What happened? This is May 25th over here. And what do you see? Bitcoin ended up plunging afterwards, right? Now over here, JP Morgan, he's bullish on growth, value stocks, sees inflation easing. This is December 27th of 2021. And right here, December 27th of 2021, what do we see? A huge crash afterwards. So, he's not always really making the best predictions. So you have to take the things that he says with a grain of salt, but keep an open mind of the possibilities and really dive deeper into what it is he's actually saying. So that's it for our slide presentation. We're going to go over to TLT now and break down the levels. So when it comes to TLT, we've been tracking a 5-wave structure to the downside, right? We have our 1, 2, 3, 4, 5, possibly taking TLT anywhere from about $80 to $90. Okay, now that's been our price target for this pattern. And the way it works is wave 1, wave 3, and wave 5. Those are 5-wave impulsive moves. So if you look here, we get a wave 1 down, 2 up, 3 down, 4 up, 5 down, and then your wave 2 and your wave 4, those are ABC corrections, right? So we get an ABC correction up, then we get our wave 3, 5-wave move to the downside. We since I've started covering and making these TLT videos, we started here on our ABC move to the upside, right? And so we really called this out really well. We rejected our 61.8% retracement level. Now, there's 3 major retracement levels that you want to pay attention to, okay? They're going to be the 61.8, the 50%, and the 38.2. The reason you do this is to spot trend continuation, right? Because nothing moves in a straight line up or down. You get a move up, retracement, continuation higher, move down, retracement, continuation lower. So you use this to spot trend continuation, but you also use this to spot reversals. Okay, so a reversal would be a move down, a retracement, a little bit of consolidation, and then you break through those retracement levels, then you're spotting a potential reversal. Now, the trend is your friend, and as you can see, we've come down, retraced to our major retracement levels, continued lower, right? Come down, retrace to major retracement levels, continue lower. Come down, retrace to major retracement levels, continue lower. Retrace to major retracement level, continue lower. Now, what's been tricky about the TLT structure right now is we have a little bit of an extended, wave 2 right here. Okay, so we're looking for this wave 1 down, 2 up, 3 down, 4 up, 5 down. We called the wave 2 bounce. Okay, so we basically we're able to find this move up here. We were looking for our sell signal, okay, which if you pay attention down here, that's going to be on the MACD. So when this blue line crosses below the orange line, that's a sell signal. So when we were in this ABC structure right here, we were really waiting to see, okay, what are we going to do? Are we possibly going to break out past our major retracement level, or are we going to come up here, consolidate a little bit and get a sell signal? And sure enough, that's what we did, and we were able to ride the momentum down to our trend line. If you notice, we have this long-term trend line that we've been rejecting multiple times. We actually broke out, retested it, and continued up higher. So if we zoom in a little bit, now that we have a general thesis of our larger structure, what we can do is we can zoom in here on, and get a closer look at everything that we've just been talking about. Let's zoom in on our MACD real quick and make it a little bit bigger. And look at what we're getting on our MACD, okay? The blue line is touching the orange line currently. Remember, we are in a perfect world scenario. The way this is going to work is 1 down, 2 up, 3 down, 4 up, and then 5 down. So we've already been following the structure and got a 1-2 bounce, but we really started to consolidate. So there is a bull flag on the chart right now. So if we happen to, basically break this trend line here, all right, now this is going to be the trend line to look out for on the daily chart. If we can break out past this trend line and head up above our major retracement level of 109.72, then there's a very good chance that we could break out of this structure. And rather than getting an ABC correction up, this actually would be a 5-wave impulsive move to break us out of our current structure, right? So 1, 2, 3 up, then here's our 4 down, and then a 5 up. Now we have a gap up here on TLT to fill right around 111. Okay, so that's going to be kind of like our gap fill to the upside is going to be about 111.50, 111.40 is the range up there. And we have 2 gaps to the downside. The reason we look at gaps is because gaps fill about 90% of the time historically in the market. So the big question is when they're going to fill, right? They may fill in a week. They may fill in a year, 5 years, right? You can't really predict, but it's very good to have them charted up. So that way you can be aware and kind of understand where the price action is being drawn to, okay? If you see we continue to head bullish in a bullish structure and we break out of the bull flag right here, then you can safely assume, hey, if we break past our 109.72, there is a higher chance that we're going to come up and fill this gap before we come down and fill these gaps, right? But again, if you take a look, what we're looking for is going to be a MACD sell signal. So if this thing can cross down below the orange line and continue and really create some space in between it, that's going to be your MACD exit signal. And it could be a sign that TLT is going to continue following our structure and come down and fill our first gap here of about 158 is going to be the bottom of the first gap down. Now there's 2 major support levels to the downside as well. We actually just gapped down this morning and we're trading below 106.33. If you take a look, we're at 106.16 right now. 106.33 is really a major support level if you're bullish on TLT. You want to see us stay above there and really hold that level of support, continue this bull flag consolidation for a breakout to the upside. Now, below 106.33, we have 102.94. 102.94 is going to be another major support level that it needs to hold for any chances of going higher. If we break below these levels and start to trade below there on the daily, again, most likely we're going to come down here and get that gap fill to about 158. And very possible that our wave 3 structure right here could take us down to the next gap fill on TLT, which would be right around 95.17. Okay, now we could bounce a little bit above there. Okay, we do have this trend line here that we've been holding. All right, and so, if we come down, we could test this trend line again and not really fill the whole gap. We could, bounce somewhere up here. Again, these are just outlines that we have drawn before the price action is even there and really, started to develop just to give us an outline and an idea of, what we're really looking for. Okay, so that's the main things. Okay, you want to look out if you're bullish, you want to look for a bull flag breakout. Okay, you want to break this trend line, break 109.72 and come up and fill the gap. All right, and if you're bearish, you want to see the MACD sell signal cross below, and you want to see it continue to cross below and stay really below that orange line there. If that does happen, most likely we're going to test our 102.94 support level. If we break through there, we'll come down and fill the gap and potentially even come and retest this trend line and fill our other gap down on TLT. Okay, so appreciate you guys watching the video. It takes patience, okay? You need to have patience. I know that everybody has been, looking to go long, looking to go short, especially if you caught the short up here or you closed your long positions and then you reopened the long positions or you closed your shorts here. A lot of people have been ready to take a trade up at these levels, but you need to have patience, okay? You need to let the structure play out. It is an extended wave 2 right here. We're really consolidating. That's why, I've drawn this bull flag structure right here. And it's a little bit tricky right now, guys. So have some patience, wait for confirmation of a MACD sell signal, wait for confirmation of a bull flag breakout. And that's basically my suggestions. Okay. Now, none of this is financial advice. I'm trying to provide you guys with unbiased technical analysis, really going over the key levels to break for the upside, key levels to break to the downside, and what really to look out for either way. So that way you can be prepared, if things continue to go higher or if things end up reversing and heading back down. Okay. So smash the like button, subscribe to the channel if you guys are new, and I'm out.